The stock market can be a tricky place, especially if you're just a beginner. It's almost like learning how to drive a car. You start off slow, you stall a couple of times whenever you release the clutch, and you make a couple of mistakes along the way, until you pass your test and then driving becomes second nature. Investing kind of works the same. You might make a few mistakes to begin with, hopefully nothing too serious, but over time it just becomes a little bit more second nature to you, and you don't actually have to think all that much about your investment portfolio. I guess what makes investing so difficult in today's day and age is the wind tunnel of information constantly coming at you. Hundreds of investing YouTube channels, tons of popular news outlets, along with an endless list of popular books to buy on Amazon. So with so much information at your fingertips, where exactly do you start as a complete investing beginner? Well, in today's video I'm going to share with you guys 6 investing tips whereby if me and you were to jump onto a one-to-one call and you were to say,
Mitch, what 6 things would you share with me about investing in order to help me get started on my journey?
The following 6 things I'm about to tell you would be exactly what I would share. So first up, we've got the first pillar, which is knowledge, and to always stick within your circle of competence. Your circle of competence is your subject area that you either have skills or expertise in, and understanding your own helps you concentrate on specific areas that you're more familiar with. It's certainly not a case of who knows the most, and instead it's just more of an understanding of what you know specifically. And regardless of how small that circle is, you're going to want to double down on the knowledge in which you have within it. It's a framework that Charlie Munger and Warren Buffett have coined, which focuses and highlights on what you know versus what you think you know. Because many investors dip their toes into areas that they think they know about, but very rarely do. Buffett once said you should know your circle of competence and stick within it. The size of the circle is not very important, but knowing its boundaries, however, is vital. But what exactly is the metric for validating what you know versus what you think you know? Well, it usually comes down to experience and interests. Let's say, for example, you've got 10 years experience working in the financial services sector. In that case, you'd probably like to say that you've probably got quite a good grip on financial services companies, and you're going to have an understanding of how they operate, how their business models work, and which ones are performing well, and therefore could be a pretty good stock investment. Then you need to think about where your interests lie too. Perhaps you're a big tech nerd that knows everything there is to know about Apple and the products in which they produce, which products are the best products and which ones are the most popular, as well as having an eye and a vision for the future trends within the tech space as well. Fundamentally, your experience and your interests will usually translate into a level of knowledge that's probably higher than that of the average person. And it's absolutely okay not to know everything, because nobody likes a know-it-all anyway. But the best way to test yourself is to actually ask yourself, if you made a stock investment, could you explain it to a 10-year-old in 60 seconds or less in a way in which they understand? And if the answer is yes, well, that stock investment is likely within your own circle of competence. But how do you go on to select the stocks that are actually going to go within that circle? Which leads me on to pillar 2, your investment portfolio, and stating that investments should be like filling out a lottery ticket. Why, you may ask? Well, because it's not a case of us gambling on a 1 in 45 million chance that our lottery numbers come up, because the odds within the stock market are far better than that anyway. But instead it's more of a philosophy of picking your stocks like you would pick your lottery numbers. Because for most people anyway, once they pick their 6 lottery numbers, they stick with them for life. And the same kind of approach should be taken when investing into stocks. You should select a handful of your highest conviction plays and then go on to invest into them over the course of the long term. And the key reason why I point this out is because investors typically are pretty poor at actively buying and selling shares. A study called The Courage of Misguided Conviction showed that the 20% of most passive investors were able to achieve an average annual rate of return of 18.5% per year, in comparison to the 20% most active investors who were only able to achieve a portfolio return of 11.4% per year. So the more passive investor outperforms the active investor to the tune of 7% per year on average, which would be absolutely huge over a long duration of time, because using the rule of 72 at a 7% rate of return per year, your money would actually double every 10 years. And let's say your investing time horizon was 30 years, that could be several 100% in potential lost returns simply because you are buying and selling shares, as opposed to that of just being a passive investor. So to summarize, if you wouldn't change your lottery numbers every week, then you shouldn't change the stocks within your portfolio every week either. But how do you create a bulletproof portfolio that's equally weighted and that can perform well? Well, that leads me on to pillar number 3, which is all about diversification, and that investing is like a box of chocolates. When someone gives you a box of chocolates, you get lots of different kinds of chocolates within the box, from caramel to fudge to hazelnut, and the list goes on. The same kind of goes for constructing an investment portfolio. You might invest into Apple stock, Alibaba, Disney, and BP. The idea here is that you want to diversify your investment portfolio across different geographic locations as well as economic sectors in order to overall reduce your risk profile. Because if we take Alibaba as an example, which has underperformed massively over the course of the past 12 months thanks to geopolitical tensions over in China, supply chain shortages, regulatory issues, and the list really does go on, and as a result, Alibaba is down 55% in the past year. Whereas if you had a stock like BP as an example, which is in a different economic sector and a different geographic location and hasn't been affected by the issues in China as such, and instead has been able to benefit from other economic events because commodity prices have gone up so much over the course of the past 12 months, along with all of the tensions in Russia and Ukraine at the moment, and as a result, BP have been massively profitable over the course of the past 12 months, and because of that, their stock price is actually up 43% in the past year. So if you do go on to pick a stock that's a little bit of a stinker, then hopefully you've also been able to pick some other stocks in some other areas that have still been able to perform quite well, and therefore still allow you to grow your return on investment every single year. But to take diversification one step further, the idea here is that over the course of the long term, that you actually go on to build a collection of diversified asset classes within your investment portfolio and not just solely focus on stocks. Because as John Bogle once says, don't look for a needle in a haystack, instead just buy the whole haystack. And whilst John Bogle was referring to index funds as opposed to individual stock picking, I'm going to translate this quote into actually diversifying across many different asset classes. Because instead you want to start accumulating as many assets as you possibly can rather than picking one single unicorn which you're relying on to provide you with all of the return on investment. So perhaps you could start to add real estate to your investment portfolio, perhaps ETFs, or perhaps even cryptocurrency. But regardless of what approach you take, remember to always try and stick within your circle of competence. Try your best to create a well-rounded investment portfolio because that will certainly help you reduce any kind of risk associated with any single adverse economic event. And whilst we're on the topic, the next thing that I'm going to share with you guys is probably one of the most important things, especially if you're an investing beginner, which is pillar number 4, which is all about risk, because risk is actually heightened when you shorten your investing time horizon. Let me be honest with you guys, declines in the stock market are extremely common, which is why reacting based on short-term price fluctuations is a loser's game, because on average we see a stock market correction of 10% every 1.6 years, a bear market of 20% every 4 years, and a full-blown stock market crash of 30% every 9 years. But if you're too busy buying and selling trying to predict and benefit from short-term price fluctuations within the market, the likelihood is you're probably going to lose out. Because according to JP Morgan, if you just missed the best 20 days of stock returns between 1999 and 2018, your average annualized return would be negative 0.33%, which is absolutely crazy because the S&P 500 was actually up 100% during that same period. So instead of actually doubling your money, you would have actually lost money. But hopefully that highlights the importance of not focusing too much on the short-term fluctuations within the stock market, and instead purely focusing on the long-term outlook instead, which if you're ever in doubt, just zoom out of your stock charts. But having said all that, how much can you actually expect to generate from investing into the stock market? Well, that leads me on to pillar number 5, which is all about reward, because compound interest is the 8th wonder of the world. Carefully selecting a group of stocks that are your highest conviction plays, which are within your circle of competence, whilst mitigating as much risk as you possibly can, should be a great concoction to maximize your investment returns. But what kind of investment returns can you actually expect? Well, if the Taj Mahal, the Great Wall of China, and the Colosseum is anything to go by, well, the compound interest effect is certainly going to be quite special. Because in actual fact, if you just started out investing with just £100 and were able to achieve a rate of return of 8% per year, over a 40-year period, making additions to your investment portfolio of £500 per month, assuming a rate of inflation of 3% per year, over that 40-year time period, your investment portfolio would be valued at £2,470,258, which using the rule of 4% would give you an annual rate of income 40 years from now of £98,810 per year to live off during retirement, which isn't too bad at all.
Yeah, boy.
But how can you absolutely maximize the returns within your investment portfolio to achieve that 8% return and beyond? Well, here is how some of the best investors have done it over the course of the past few decades, which leads me on to the sixth and final pillar, which is all about psychology and being greedy when others are fearful. Between 1998 and 2016, the stock market actually traded down in the negative 46.7% of the trading days available. So in essence, nearly 1 in every 2 days the stock market was red. And of course, some of those days are worse than others. But when fear spreads throughout the market, that's your opportunity to buy in. As Buffett says, be greedy when others are fearful. Because when stocks go down, that should be great news for you as an investor. Because it's just like going down to the shops, your favorite clothes shop, and getting a 10 or 20% discount on the item of clothing that you were simply gonna buy anyway. For me personally, I love it when we get a little bit of a short-term market correction, because it means for me, I can pick up additional shares in the companies that I'm most bullish on for a cheaper price than I could yesterday. Because I'm a net buyer of stocks, I'm accumulating as many shares as I possibly can. And the cheaper the price that I can acquire those collection of shares for, the better it is for me over the course of the long term. So certainly don't be fearful or perhaps even stressed when stock market prices go down, and instead think about it as an opportunity to capitalize over the course of your investing lifetime. So they are, guys, my 6 pillars of investing. If you do want to learn a little bit more about how I personally plan to retire from investing into the stock market, then be sure to click on this video here. Be sure to drop a like on this video, guys, if you did enjoy it. Subscribe to the channel if you're new around here. And with that being said, see you over in the next video.